Hi, my name is Vincent Scarsella, Director of Research and Investment Development at Sgroi Financial. On today's edition of Market Moves, we will be going over everything that happened in the second quarter of 2024 and also what we are looking at for the back half of the year. The second quarter of 2024 can be compared to the first quarter of 2023, as growth dominated over value and technology was the main driver of performance. The tech-heavy NASDAQ rose 8.5%, the S&P advanced 4.3%, and the Dow, which does not have as heavy of a weighting to growth and technology, declined 1.3%. Rounding out performance, small caps, as measured by the Russell 2000, was down 3.3%. All in all, the S&P 500 has posted 31 new all-time highs in the first 6 months of 2024. Stocks started the second quarter with some volatility as stubbornly high inflation sent stocks falling in April amid worries that the Federal Reserve would be forced to keep interest rates higher for longer. Even as the Fed has signaled 1 or 2 rate cuts are in the cards, down from 7 at the start of the year, stocks roared back to finish in the green thanks to improving inflation data and strong corporate earnings. Looking out over a broader lens, all of the major indices are positive for the first half of the year. The NASDAQ has risen 18.6%, the S&P is up 15.3%, the Dow has advanced 4.8%, and small caps are up 1.7%. Much of the gain in both the NASDAQ and the S&P can once again be attributed to the technology and Mag 7. After a sluggish start to the year, the Mag 7 is once again magnificent. All outperformed the broader market, with only Meta underperforming the S&P slightly in the second quarter. Year to date, Nvidia is up almost 150%, Meta is up 43%, Alphabet has risen over 30%, Amazon over 27%, Microsoft 19.3%, with only Apple and Tesla trailing the index. Turning to sectors of the market, only 4 produced positive return. Technology, communications, utilities, and consumer staples were in the green, rising 8.8%, 5.2%, 4.6%, and 1% respectively. The tech sector is concentrated in 3 of those Mag 7 names, as Microsoft, Nvidia, and Apple account for over 50% of the weighting in the sector, while Meta and Alphabet make up more than 46% of the communication services sector. The biggest laggard sector-wise for the quarter was materials, which fell 4.5%. Fixed income, after posting a negative first quarter, was up slightly in the second. The Bloomberg U.S. Aggregate Bond Index rose 0.07%. However, after bottoming in late April, the index is up more than 2.8% as declining inflationary data combined with investor confidence that the Fed will cut rates sooner rather than later lowered yields and added some price appreciation back to the fixed income market. Moving to what's next for markets, growth and inflation continue to show signs of moderation, with the latest CPI and PCE ratings coming in below expectations. Job numbers and wage growth continue to remain resilient, and with that, signs the Fed can accomplish that soft landing where inflation cools and the economy avoids a recession are growing. The biggest reason many expect that soft landing is drawn from expectations that growth and inflation will moderate because consumer spending is unlikely to stay at the pace it has been on, and wage growth, although remaining strong, has potentially peaked, which makes the threat of a reacceleration in inflation a low risk. As we look ahead to the fall, it is an election year, and there is a chance that election results in the US could elevate volatility across markets. It is important to remember that expressing views on whichever political party you may support should not be done within your portfolio. Rather, expressing your political views should be done at the ballot box, as history shows that the stock market really does not care who is in office, and making decisions based on beliefs that Republicans or Democrats are bad for the stock market will significantly affect your portfolio in a negative way for the long term. Some strategists say the rally in the technology stocks looks overblown, with rich valuations and just a handful of high flyers pushing the market higher. Looking at the equally weighted version of the S&P 500, it has trailed the S&P 500 by 10% since January, which is the widest underperformance in the first 6 months of the year ever. If the market wants to continue to chug higher from here, companies outside of technology need to perform. Since 1990, 4 prior bull markets saw the equal weight index outpace the S&P by 15 percentage points on average. Another area of the market to look at is growth versus value. Year to date, the growth index is up more than 20.5%, while the value index is up 6.5%. This wide dispersion probably cannot continue, so if we do see a rotation out of tech, value areas of the market may catch a bid higher. Lastly, bonds have seen some volatility this year, but we remain very constructive here. Today is a different world for fixed income investing compared with pre-pandemic levels. After a string of central bank rate hikes, 86% of global fixed income assets are now yielding 4% or more versus less than 20% in the decade leading up to the pandemic. This means that investors no longer need to take on an extra risk to generate income. Many companies took advantage of low rates early in the pandemic and have less than 10% of outstanding debt coming due through 2030. What all this means is that bonds will be bonds once again, and once we do get a rate cut, yields will fall and bond prices will eventually rise, and big gains could therefore be seen in this part of the market. Thanks for watching this episode of Market Moves. If you do have any questions, please do not hesitate to reach out.